Should investors use stop loss orders as a risk management tool? I will answer that question and show you the proper way to use stops, as well as provide my regular weekly market analysis. We had a pretty good jump last week. Let's see what that means for a Santa Claus rally. And then I will look at the day trade of the week on CGC. So let's begin with what is a stop loss order. It's an automatic order that you put with your broker to sell your stock if it hits a certain price level. So you could buy a stock at $10 and put a stop loss order to sell that stock if it hits $9. That would be a stop loss, and you would incur a 10% loss. Stops are good in terms of being a risk management tool, provided they are used correctly. And so often they are not. One of the common mistakes is to use a simple percentage drawdown to define where the stop should be. So what is a 10% drop from $10 to $9? That would be a 10% drop. And many people will do that. But that makes no sense because every stock has its own volatility historically. For some stocks, a 10% move may be very substantial. On other stocks, a 10% move could be what it does in a couple of hours, for example, a penny stock. So don't use percentage stops. What you should do instead is what I'm going to show you in a moment, and that is using inflection points as your stop loss area. Now, from experience, I will tell you that it is better to use what I call a stop on close concept. Now, stop on close is not an order that you can set with your broker. What it is a concept. If the stock closes below, like closes the day or the week, or if you're intraday trading, even the 15-minute bar, if it closes below your stop loss price, then you sell at the next day or the following Monday after a week, that sort of thing. And the reason you should do it that way is because it allows for stocks that have less liquidity, in other words, less actively traded, to have those little pullbacks that sometimes happen because of that lack of liquidity. They might go down a little bit through the day and then end up coming right back and still close above the stop loss price. So I like to use that for longer term trading. Now, when day trading or swing trading, where it's shorter term, a much faster moving trade, then I think a hard stop, a normal stop loss order, makes some sense. Now let's look at some charts to show you how a very simple method to know where to put your stop. And again, we don't want to get into this idea of selling just because it hits a stop loss at minus 10% or when you're down a $500 loss or something like that. Instead, what you want to do is look at where the last inflection point low is. So if we use this as the entry point on this stock, T.SCL, it had an abnormal volume day, abnormal price, and you'll know that that is important to my methodology. And you can see that your entry here and the last inflection point is where it stopped going down and started going up. So that would be right here. So that would be your stop loss price. And then you can move your stop every time you move to a new high, you look to the previous inflection point. So you move to a new high, go to the previous inflection point. New high, previous inflection point. New high, previous inflection point. And so on and so on. Here you go, new high, previous inflection point. So if you were in this trade, the current stop loss would be at 1150. However, don't put stops at even values. If you're going to use an actual hard stop, which again, on this trade, because this is a daily chart, I would rather look for it to close below 1150. But if you're going to use an actual hard stop, don't put it at 1150, put it at 1149. And the reason for that is there will be lots of people lined up at psychological barriers like 1150 with buy orders. And if it goes through that psychological barrier, that's meaningful. And so I always put stops at kind of weird numbers, 1149 instead of 1150 or 9.99 instead of $10. All right, now let's look at another example. This is a stock on a weekly chart. And what I want to show you here is how using a stop at the last inflection point made some sense. Whoops, back here. So So there is our last inflection point right there, and we closed below on that week, and you see the stock fell quite sharply. It then broke up from a rising bottom here, so that would have been a good buy point. Now look, every time you move to new highs, go to the last inflection point. New highs, last inflection. You kind of get to a new high right there, I think. So then you go to last inflection, which means you would be out here. So you're in here, you're out there, and it never really went a whole lot higher. More recently, I had a buy on this stock right here because it broke the downward trend line from a rising bottom. So at that point, your stop would be there. And again, it would have to close that week below that price. It never did that. It hit it, but it never did that. And now you're still in the stock. It's gone from $47 to $60. Let's use one more example, and this is a short-term trade. SHPH came alive on Friday. You can see it was very boring on Thursday, even into Friday morning, and then it came alive. So I've got algorithms that find that. It looks through every stock trading in real time, looking for algorithms, looking for abnormal activity with computers' help. And that's something we do on our active live service every day at Stockscores. So that would be the entry point. So then you move to a new high after a pullback, stop gets moved up to here. Initially it would be there. And then you hit a new high after a pullback, so stop goes there. Hit a new high after a pullback, stop goes there. It doesn't close below, but it hits it. Goes to a new high, stop goes here. And then finally you get stopped out right there, and that's a great way, a very simple way to know when to stick with the trade and when to get out. Just use those rising inflection points in upward trends. It works really well. All right, let's get into this week's analysis of the markets. We'll jump into stockscores.com, my website, of course. And let's look at the S&P first on the short-term chart. This is the 1 month, 2 hour chart. And you can see that the bottoms are rising, so the buyers are in control. It is bullish in the short term. In the long term, looking at the 3-year chart, we've got a very interesting situation. We are just starting to tickle through that downward trend line. That is a positive sign. You can see our sentiment stock score is in the green now. It went above 60. And so we're starting to see that real buyers taking control. This week was an important week for the market because we had the market interpret the speech by Fed Chairman Jerome Powell favorably. And then when the jobs number came out on Friday, it was bad at the open. The market gapped down on the open, and then it moved up from that. And so what you have then is a situation where the market reacted positively to good news, but also positively to bad news. That jobs number was not good for the inflation outlook, and yet the market still reacted favorably. And that's a strong sign that the buyers are finally starting to take control. And I think there's a pretty good chance we're going to see that Santa Claus rally. All right, let's take a look at some of the other markets that I like to look at. We'll try the IWM, which is the small cap stocks in the US, and we'll make this a 3-year chart. And here it's actually a better chart because we broke the downward trend line some time ago, and then we've done it again just barely this week after making a double bottom. So that's a favorable chart. The small caps actually look better than the large caps. How about the Canadian market? T.XIU. Let's look at the 1 month first. Who's in control? Buyers are in control because there's rising bottoms. Okay, so that's a bullish chart in the short term. In the long term, you've got what's building to be a head and shoulders bottoming pattern. We may pull back and then move higher. Not a lot of upside because here's resistance, but I think it's a good chart, not a great chart in the long term. How about commodities? So let's take a look at gold first because gold was very noteworthy this week, making pretty good gains. Let's look at it on the 1 month chart, and you can see that the buyers are in control. We've got rising bottoms on the chart. How about on the 3-year time frame? We've broken the downward trend. We've built a rising bottom, and now we're breaking up from a rising bottom. That's a pretty good signal that gold is likely to go higher. How about oil? USO is our oil chart. Let's look at the 1 month chart first. And you can see the downward trend line has been broken, and we're starting to build some rising bottoms, a little bit of weakness at the end of last week. So it's better, but it's not great yet. How about the 3-year chart? Here you can see the 3-year chart's long-term upward trend line right there, and we're just dancing along it. It's like the oil market is kind of hanging by its fingernails. Is it going to hold that chart? We have made a falling top, so we could break down through it. Keep a close eye on this because it's at a very critical point. All right, let's take a look at the US dollar now, which is pretty important for commodities. And you can see that the US dollar continues to move lower. The tops are falling. If we look at the 3-year weekly chart, we're coming down to that trend line. We're not there yet, so there's still more downside for the US dollar. And if that continues, that should be supportive for gold, fairly supportive for small cap stocks in general, actually. A strong US dollar is not really that great for US stocks. All right, how about Bitcoin? Let's take a look at GBTC. It's really been decimated, and we've been bearish on this weekly video for a long time. It's still in that long-term downward trend. However, on the short-term chart, you're starting to see some rising bottoms. If we could break up through this, we may get a little bit of a bounce back. I don't see a strong signal yet, but I think the chart is improving in the short term. And then finally, let's take a look at the interest rate market. TBT is the proxy I use for interest rates. You can see the pretty sharp decline from very overbought conditions for interest rates, and we're pretty much back to this trend line. So interest rates have fallen. I think we're going to see them bounce, and that's one concern I have for stocks, is that we may see the bond market pull back, which would mean interest rates would inch back up a little bit. But I don't think we're going to go to new highs for interest rates. I think we may just start to stabilize in this zone here for the interest rate market. All right, so what are my ratings then? US stocks, neutral long-term, bullish short-term. I think Canadian stocks look a little better, but I've got the same rating, neutral long-term and bullish short-term. Gold, I've switched now to bullish on both time frames. Oil, neutral on both time frames, although you could say in the short term it's still a little bit negative. US dollar, long-term neutral, short-term bearish. Bitcoin, bearish long-term, but I've upped my rating to neutral short-term as it is trying to stabilize. And then interest rates, long-term neutral. We are at that trend line where it should bounce, but bearish in the short term. All right, let's take a look now at our day trade of the week. This is an example of a stock that got picked up by those algorithms I talked about that we run on Active Live. You can learn more about Active Live and my courses and that sort of thing at stockscores.com. So this is CGC. I've seen a lot of life in the cannabis sector this week, and I think this is an area for longer term traders to keep an eye on as well. But CGC was a good day trade on Friday using what we call the pullback play or the intraday pullback play. It's all driven by algorithms. And here is my algorithm as it runs in a program called TradeStation. And I have this running for our Active Live members every day. So the entry point was at 1028. That's right here. That's because there's a little yellow dot there. And for $100 of risk, the position size was 1,660 shares. That was $6,590 of capital for every $100 of risk. But with margin, you can leverage that 3-to-1, so it becomes $2,200 of capital required. By the end of the day, the stock had closed at 5.17 RR, which meant a $517 gain on that $2,200 of capital required, a 23% return on a one-day hold. Nice day trade in a market that wasn't exceptionally strong, but still definitely getting better. And it feels like that Santa Claus rally is coming. So I'm curious, do you use stop losses to manage risk? Let me know in the comments. And of course, if you like this video, hit the thumbs up button, subscribe to the channel, and most importantly, trade well.